Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. And this first question is from Darren. He wants to know, if I'm invested properly for income, how bad can a recession really hurt me? All right, Darren, let's dive deeper into that, right? How a recession can actually impact your retirement income strategy when you're invested for income. Now, first, if you're kind of strategically investing for income and you're several years away from retirement, a recession can present both challenges and opportunities. On the positive side, during a recession, asset prices often decline, including stocks and other investments. Now, this can be advantageous for income-focused investors because it allows you to reinvest your dividends and invest at lower prices, effectively buying more shares or units of your investments. Now, when the market eventually rebounds, the increased holdings can potentially accelerate your portfolio's growth. This means you might be able to reach your retirement goals sooner than expected if you continue to reinvest your income during market downturns. However, there are potential downsides to consider. Recessions often lead to higher unemployment rate and really job insecurity. So if you're still working and nearing retirement age, being laid off during a recession can disrupt your retirement plans significantly. So older, more experienced employees are sometimes targeted for layoffs due to higher salaries, which could force you into early retirement before you're financially prepared. So this underscores the importance of having a robust emergency fund and really contingency plan to kind of weather unexpected employment changes during economic downturns. So for those heavily invested in bonds or bond-like instruments, another consideration during a recession is the impact of declining interest rates. When interest rates fall, bond prices tend to rise, which can lower future returns on reinvested income. This means your income growth might slow down compared to higher interest rate kind of environments, potentially requiring you to extend your working years slightly to compensate for slower income growth. Now, despite these potential challenges, the good news is that a well-diversified portfolio designed for income generation and capital preservation can mitigate the impact of a recession on your retirement plans by focusing on high-quality dividend-paying stocks, bonds with manageable durations, and possibly including alternative income sources like real estate investment trusts or dividend-focused funds or something like that, or even dividend stocks, right? You can build a resilient portfolio. Ultimately, the goal is to kind of structure your investments to provide a steady stream of income while minimizing volatility and risk. Now, this approach not only helps you weather economic downturns, but also allows you to stay on track towards your retirement goals, even in challenging market conditions. Great question. As always, if you would like to send in your question, you can do so. You can email them to poollocke@poollocke.com. And let's get to our second question today. And our second question is from Penelope. She says, I feel like President Trump was very pro-business, and this seemed to really affect the economy and make it better overall. So he was influential, wasn't he? Oh, absolutely, Penelope. He wasn't his first time. He continues to be this time as well, sometimes for good, sometimes not so much, right? But it touches on a crucial aspect of how political decisions can impact the economy and subsequently affect investments, especially for those focused on generating income in retirement. Now, indeed, a president's stance on business and taxation policies can have kind of ripple effects throughout the economy. For instance, a pro-business approach typically involves policies aimed at reducing regulations, lowering corporate taxes, and incentivizing investments which can stimulate economic growth and positively influence stock market performance. Now, conversely, policies that increase taxes, especially on capital gains or corporate earnings, may dampen investor sentiment and potentially lead to market volatility. Now, during President Trump's kind of, first stint in office, his administration implemented several pro-business policies that were perceived positively by markets: lower corporate taxes, deregulation. That was kind of among the key initiatives. Got kind of buoyed investor confidence and contributed to a robust economic environment. However, it's essential to recognize that the impact of such policies isn't always immediate. There's often a lag between policy implementation and its effect on the economy and the markets. Now, moreover, subsequent administrations may introduce policies that could be perceived as less favorable to business interests. Despite this, the markets have shown resilience over time, adapting to various policy changes and economic conditions. Now, for investors focused on income in retirement, particularly those conservatively positioned in bonds and bond-like instruments, the effects of political shifts on their portfolios may be less pronounced, right? Bonds, by nature, represent debt obligations of issuers. Now, whether they're corporations or governments, as long as these entities remain solvent and capable of meeting their debt obligations, bondholders typically continue to receive interest payments as agreed upon. Now, this inherent stability in bonds provides a cushion against market fluctuations driven by political developments. Even in scenarios where equity markets may experience turbulence due to perceived shifts in business policies, income-focused investors in bonds can maintain a more predictable stream of income. So really, in conclusion, while presidential policies and their implications for business can influence market dynamics, investors committed to income strategies in retirement can mitigate political risks by diversifying into stable, fixed income investments. This approach helps insulate portfolios from short-term market volatility and aligns with long-term financial objectives. Great questions today. If you would like to send in your question, please do so. You can email them to poollocke@poollocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.